This trader just made $56,000 in one day. But there's one key detail most people misunderstand with this strategy. And if you miss it, you might end up on the losing side of the market. You might end up on the losing side of the market with this trade. Which is why today we're going to review Jade Cap's breakdown of this SMT divergence strategy, how he made that 56K, and look at the real risks behind these kind of moves. And the truth is, if you trade this strategy without knowing, all the tiny little but very important details, you could be making a very expensive mistake. Let's get into it.
Dollars in one day using SMT divergence. I know these setups seem complicated, and most traders take every single divergence and wonder why they keep losing money. I used to do the same exact thing until I discovered what I'm about to share, and it completely changed my trading. In this video, I'm going to break down exactly how I spotted it, entered the trade, and managed the position, and how you guys can spot these setups too. So without wasting any more time, let's get right into it. Okay, let's first talk about what
Okay, so you know my goal is to make these videos 10 times more valuable for you, so you're 10 times more likely to apply them and get some of this. So first of all, we got the claim that he made 56K in one day using this SMT divergence strategy. Now, what's the common mistake that you want to avoid? Most traders misuse SMT and they take every divergence leading to losses. So he's going to teach us how to correctly identify this trade setup and get that working for us for better results.
SMT divergence actually is. In simple terms, it's really gauging two correlated or inversely correlated assets, whether they are strong versus weak. So we're talking about relative strength and weakness across two correlated or inversely correlated assets. Now, for the purposes of this video and trade breakdown, I'm going to be talking about the dollar against the euro, because that's the trade that I took, but this will also work with index markets. So for this example, we've got the euro dollar. You guys can see here very clearly that this pair, right, is going to be correlated with the dollar because it's measured against it. But this will also work if you're trading index markets like NQ, ES, and YM. So NQ, right, NASDAQ, ES, and the Dow. When we're trying to find relative strength versus weakness, if we're measuring all three of these together, this is how we're going to be able to spot SMT divergence. Now,
okay, so relative strength versus weakness. Okay, so you got that relative strength versus weakness. So pay special attention to that. Now, what we're doing here is we're comparing two correlated or inversely correlated assets to gauge relative strength or weakness. You guys got that, right? And the key concept is that markets that move in sync, there's markets that should, right? And there's markets that don't. So when a market is known to be correlated with another market, and then suddenly they're not moving together, that's called a divergence. Divergence just means difference, right?
Now, like, what is SMT divergence and how can we spot it? Essentially what it is we have two markets that are not in agreement, so they're not in sync. That's causing the divergence.
Not in agreement. Okay, much easier way to say it.
So for this example, what I'm looking for is this. So the the dollar is creating a higher high, but that means the euro, right, if the markets were in sync and there wasn't any divergence, that means the euro would create a lower low. But in this trade example, that's not the case. So for the purposes of this video and spotting SMT divergence, essentially what this means is, let's say we have the dollar here and the euro.
So you got two different markets, right? You guys get the concept. Just get the basic concept before anything else. We've got two different markets. In this case, it could be DXY and euro, okay? And we're going to say, okay, what is the relationship between these two, right? Are they in agreement or are they not in agreement?
Really what this signals to us is that there's strength, overall relative strength in the euro. This is where we're going to be able to spot where smart money is accumulating long positions, because if the dollar is creating that higher high, euro really, if the markets were in sync, euro should be creating the lower low. Okay, but it's not doing that. It's not creating that lower low. So if markets were in sync and dollar really wanted to continue higher, right, you need to see euro going lower. So just quickly, very easily representing this, you have previous day's high. So when we have a previous daily high being swept out on the dollar, what would you expect? You would expect the previous daily low to be swept on the euro. When you don't see it being swept out, this is giving you the indication that there's strength in the euro. Okay, very simply put, when we're looking for divergence, these markets should be in sync because they're inversely correlated. Okay? And
so we've got correlated and inversely correlated, right? So some example correlated pairs are the dollar, DXY, and the euro versus the dollar. All right, so that would be one example. And then another example is the NASDAQ and the S&P and the Dow, right? If you want to look at this, let's look at this right now, okay? Let's look at this right this second. This is the S&P. Okay, so I'm looking at the S&P right now. Now let's zoom out to a higher time frame and see if we can apply or just evaluate what he's talking about. Okay, so this is the hourly chart of the S&P. All right, now what I'm going to do on the left-hand side of my screen is I'm going to put the NQ, okay? So, and let's remove all of our drawings so that we can just see this from an hourly time frame and an hourly time frame. Okay, so we'll look at, on the right-hand side, we'll look at 10 bars, about 10 bars of data. Okay, so that's the 10 bars of data. Now look, this is the S&P 500 futures, and then this is the NASDAQ futures, and we're looking at 10 bars. Okay, so let's make them about the same size. Okay, now tell me if these, to you, look similar. Okay, post in the chat right now. Do these look like they are correlated, or do they look like they're not correlated? Do they look like they're in agreement? Or do they look like they're not in agreement? Tell me in the comments right now. What do you see? Okay? Because I can tell you what I see, but it matters more what you see because I'm here to help you. Okay? So correlated, right? Isn't that what you see? Post in the chat right now if you see that. Doesn't this look similar to this? In fact, aren't they like a splitting image of each other? Now, that's because this is correlated. Okay? So I see in the chat, you guys are saying, Hamza's like, yeah, he sees it, right? Like, is this that difficult? You could teach this to a 5-year-old, okay? Correlated. So how is this divergence strategy going to work? It's going to work when you see a pattern here that starts to emerge that looks different. Now they look the same. So this means that they're correlated generally, and they are correlated generally, okay? But what happens when they stop looking the same? Right? That's going to give us an entry for a trade, right? So this is a trade setup called divergence, and that's the strategy. We're taking something which is a pattern. The pattern is these tend to look the same. That's the pattern, okay? It's a little more complicated because this is two patterns, and you got to compare the patterns, but this is patterns about patterns. It's like trade inception, okay? Patterns on patterns on patterns, okay? But look, these look the same or almost identical most of the time. NASDAQ, S&P. But what happens when they don't? That's what we're talking about in this strategy. And what we haven't gotten to yet is how to actually place a trade when that happens. So let's get to that next.
The market structure should be in agreement. When it's out of agreement and out of alignment, there's an opportunity for us to take advantage of that in the market. Just very similarly with like NQ and ES. Let's say ES is creating a higher high. Let's say if we're bearish. ES created the higher high, but NQ failed to make a higher high. Which one is going to be the weaker asset? So we have ES here, and we have NQ here. Which one of these is the weaker asset? Very clearly, it's NQ, because it's creating a lower high. So when we're trying to filter out our trades and our markets that we're trying to trade, we're trying to go to the asset that is relatively strong or weak versus the baseline that we're looking at.
Okay, cool. So he's explained this pretty clearly, right? We're looking for strength or weakness. We're trying to gauge relative strength versus weakness, meaning where one's weak and the other one's strong. And why would he say that in the NQ, if we're comparing this guy to this guy, why? Why would he say that this one looks weak? Why? Because there's a lower high, but he didn't say what that means. What that means is that the sellers are stronger in this case because the sellers protected this area. You can see it like a battle, okay? Like a war between two sides, the bears and the bulls. And what you can see is that when the price tried to go up, right? That's this move here. You could see that the bears defended their territory and they did not let the bulls encroach into their space. They prevented the bulls from getting into this area, and instead they reversed the price down. If the price is going down, the bears are winning. Now, what happened on the ES? In this case, the opposite happened. The bulls tried to encroach into that space of the bears, and the bears failed to protect their territory. And now the bulls are sticking it to the bears, and they are continuing to win and take over control after we surpass that prior high. Okay.
Okay. So if you're trying to pick a long position between the euro and the pound, let's say the pound created a lower low. Well, that's telling you that that market is actually weaker than the euro because the euro failed to make that lower low. So if I had to choose a market to trade, right, if Dixie's making that higher high, right, but I'm overall bearish on the dollar index, I'm looking for that asset that is going to show me overall strength. So instead of me trading the pound, I'm going to go into the euro. And this is something that I learned over many, many years, was when I had a bias on a baseline. So for this example, the dollar, when I had a bias, I would try and short, let's say if I was bullish on the dollar, I would try and short the euro, the pound, the Aussie dollar, the New Zealand dollar, all at the same time. And what would happen was some of those currencies showed relative strength. So if I was expecting every single foreign currency to go down, some of them were actually going up. Okay, so you're trying to find the market that aligns with the bias that you're using from the baseline, because you're not trying to short every single foreign currency when we get a setup. Okay, it doesn't work like that. Sometimes you'll see the euro much weaker than the pound and much weaker than the Aussie dollar. Sometimes when the dollar is doing one thing, those foreign currencies could be doing the complete opposite because they have relative strength or weakness versus the dollar. So when I'm trying to spot out SMT divergences and how I actually trade them, because not all SMT divergences are going to work the same. Some of them will be strong. The key is you need to have a high time frame draw on liquidity. So breaking down this dollar.
Okay, so let's underline that. What you want is a liquidity trap, right? Where's the smart money accumulating? Now, ICT traders talk about this in this way, but really what this is support and resistance. You've heard of support and resistance. So you can call it liquidity traps or support and resistance, but you want to know the process. So step one, we're looking for relative strength. Which asset is stronger or weaker? We just explained how to do that with the higher highs and lower highs, right? Are the bulls encroaching into the bear territory? Are the bears protecting their area? You want to look for that relative strength. Step one. Step two, look for liquidity traps. What that means is, what is going to happen when we get to those support and resistance areas? And what you want is you want the price to move into one of those support and resistance areas and then reverse, okay? So then we're going to get into step three. So step one, step two, step three, reverse signals. When one market is faking a breakout while the other isn't confirming. Now, a fake breakout is a failed breakout. Breakouts either fail or succeed, okay? So that's what we want to keep in mind. And we're looking for those reversal signals, which would be a failed breakout. Because if a breakout fails, if the price tries to break out of a level, right? Like look at right here, okay? Look at right here as an example of this. Look at right here as an example of this. The price tried to break out of this area, right? Here was the high previously. And what happened? The price tried to break out above that high. It got a few ticks above that high, but then look what happened. The breakout failed, reversed down. This candle closed bearish. And then what happened? Boom. Okay, so that is a breakout that fails and then reverses down. And then look, the same thing happened here. Breakout, tried to break out above that high, fails, and then reverse down. Okay, so that would be a failed breakout and a reversal signal. But let's see how JadeCap does it.
Chart. Okay, so this is Tuesday, the 11th of February. Now, if you check your calendars, Wednesday was actually CPI. So what I'm looking for ahead of the CPI release are just indications that maybe the draw on liquidity is either higher or lower. So when I come into this market, all right, I'm spotting out what? This pin bar. We're trading up in this order block. We have a nice bearish fair value gap, and we have low resistance liquidity below us. So we have these daily lows that are below us. Now, ahead of the market open, I don't know if this market is going to trade lower, but I have somewhat of an indication where my draw is, okay? So I am bearish on the dollar. Regardless of whatever price action appears overnight, I'm bearish on the dollar just based on what I'm seeing in the market right now.
Okay, now let's go back to that and see why he would say that. Here's a simple reason. You've got a lower high, right? You've got the high here. We can see that. Then the high was here. So now you have a lower high. And then let's look at the next time the price tried to break out to the upside and failed. So you got the high was here, then it was here, now it's here. That means you're getting lower highs. And if you look to the left, it also happened here. So it's been happening here. Here to here, lower high. Here to here, lower high. Here to here, lower high. Okay? So bearish is not a bad idea there. Now you can make the same argument to the bull case because the low is here, then the low is here, okay? But you can see that the price was moving up pretty intensely, and then you got this very strong bear breakout, and you can see that the selling pressure here is now building, which gives you reason to be bearish here, okay? So that's why he would be bearish there. But let's take a question from the comments. Now, if you have a question, post in the comments. I'll do my best to answer you. Hamza says, you have two groups. One has stronger sellers and one has stronger buyers. What is the criteria for the right strong? Okay. And the answer, Hamza, is the strong one is the one with stronger buyers, because in trading, we're talking about strength as buying pressure and we're talking about weakness as selling pressure. So that's the answer. If the question is what is the criteria for the right strong, you just have to understand that the strong one is going to be the one where there's buying pressure, okay?
What I'm seeing in the market right now. Now, looking at the euro, I have a very clear draw on liquidity up here. So these are my equal highs that I'm trying to target.
Okay, so remember we talked about drawn liquidity as support and resistance? This would be a resistance area because you've got prior highs here. You've got this double top, okay? So we can call it a drawn liquidity or resistance area. What he means by drawn liquidity, in case you're not familiar, is that we're trying to look for the price to go into this area and see a failed breakout, just like I explained to you before. So he's saying, I want that to happen here. And he's saying it's a magnet because support and resistance areas are magnets. We don't know what's going to happen there. It's an area of interest and it's a magnet. So what he's saying he wants to see is the price to move into that area, fail, and then reverse.
Not only that, but we have this daily volume imbalance. And we have a daily inverted fair value gap. So we have a lot of indications that the euro actually wants to trade towards these equal highs. Again, this is Tuesday, the day before CPI. By the way, guys, SMT divergence is just one of the many trading setups that I use in my day-to-day process. If you guys are looking for a full download SMT divergence. So we're just walking through price action right now. We're coming up very close towards the actual news release. So we have our previous daily high there, right? And just keep in mind we have this daily fair value gap that we're also looking at. So here's our CPI print. Okay, and this is on a 1 hour time frame, mind you. As we're taking out this previous daily high.
Remember we said he was looking for a failed breakout in that area. So that's what's starting to happen now because this bull bar was real big, right? Look how big this candle was. This candle, it was the equal size of what, like 30 candles to the left? Huge, okay? And then it's starting to fail here. Okay, so this is what we talked about with the failed breakout into that resistance area.
All of a sudden, I need to spot the market that I'm trying to trade. So if I am bullish on the euro, if I flip over into this chart, okay, this is actually our previous daily low. So if I bring up this is our Tuesday's low. Now if I drop back down again into the lower time frame, now notice how the euro did not take out its previous daily low, while dollar took out its previous daily high. So if we're measuring these side by side,
now he's going to show us the divergence. So look at the divergence. You want to compare, just like we showed you with this chart here, right? We're saying we're putting one chart on one side and one chart on the other, and we're going to see if the pattern is similar or if it's breaking the pattern. If there's a difference, divergence means difference, right? So let's see if we can spot a difference.
Right? The euro is doing this. It's creating a higher low, but the dollar is doing this. It's creating a higher high. Okay, so that's automatically tipping off that the euro is showing strength. So when I see this occurring, us failing to take out the previous daily low, this to me shows that the euro is very, very strong. Because if the dollar is taking out its previous daily high, the euro should be taking out its daily low.
Because they're inversely correlated, right? They're inversely correlated. So that would be the opposite of what we are looking at right now, which is the S&P and the NASDAQ. The S&P and the NASDAQ, as you can see, are correlated, not inversely correlated.
Market were to go lower. That is when markets are in sync. But when we have SMT divergence showing us this, okay, so not only is it failing to take out the previous daily low, we're also trading into what? A daily volume imbalance as well as a daily inverted fair value gap. And our draw is all the way up here. Our draw is all the way up here in the form of equal highs. So really what we're looking to
equal high means a double top.
Do is just go long because we're assuming that this run on this previous daily high is what? A false run on liquidity. So this here, we also have a 1 hour bearish fair value gap. So when we're looking at this, this is how we're able to spot if this run on liquidity is false or not by looking at other assets. We need to pay attention very closely because the euro is in a really, really great spot to go long and touch trade this level and put our stop loss possibly at the low. Right, we might put our stop loss. If we were going long in here, maybe we want to even just use the low end of the daily fair value gap or the daily volume imbalance and go long as a touch trade. So as soon as that hourly candle closes, let's just say you entered at the top of the hour. And with CPI, I typically give myself, anywhere from 15 minutes to half hour, all the way up until an hour before I actually participate in the market.
Okay, so that's a really important tip. There are these reports that happen. CPI is one of them. FOMC is another one, okay? And if you're not sure what this means, if you're new to trading, just go to financialjuice.com and it'll tell you if there are any of these reports that are going to be released. And when these reports are released, they drastically affect the market, okay? Like the Fed changing interest rates or the CPI data, which is a consumer price index. You don't even need to know what it is. You just need to know that it's going to cause ripples in the market, big ones, okay? And what he's saying, I also do as well. And I strongly recommend, which is when one of these reports drops, that you wait at least 15, 30 minutes. He's saying he'll wait up to an hour sometimes for things to stabilize a little bit because it's like taking a giant rock and throwing it into a pond. It's going to cause all these ripples. So you want things to die down a little bit before you get in there and start trading.
So at the closure of this hourly candle, we could just assume that this run lowers is false because we're not taking out the previous daily low. There's strength in the euro. So I'm trying to position myself long. Okay, I'm not entered. There's no confirmation that I'm waiting for. The only confirmation that I'm getting is that this market is strong because we did not take out the low. So you can touch trade this level, enter long as soon as the candle closes with a target, maybe at this swing high here.
Now, what are you seeing on the chart? I don't know what you see, but what I see is I see a bull trend and I see something like a 50% pullback, right? The price pulled back. If we take the pullback to be right here, now this, if we measure the bull trend from here, this low, all the way up to the highest high that it got, just this little trend right here, okay? This is about 50% of that move up, okay? So what I see is a bull trend. I see a 50% pullback, right? And then I see a very strong bull bar closing near its high with almost no tail. So then what you have is a breakout pullback buy setup for trend continuation, which is a great setup. So now if we're going to trade this long, we have 2 reasons to enter the trade. And no, you need at least 2 reasons to enter a trade. Ideally 3, but he has at least 2 right now. One is, this is just a great buy setup, period, because you have a trap here, trapping the bears into selling short, and the bulls are going to get back in long so that they can continue to push the price up. So that's a great setup because all the weak bulls, as soon as they saw this big bear bar closing on its low, they panicked out, okay? So then the bulls are the strong bulls are gonna get back in and start buying again, okay? So you have a long setup for one reason, because you've got a great buy pullback, right? But then the other reason is the divergence, right? And that's the whole essence of his strategy here was the divergence. So you put those two data points together and you have two good reasons to enter a trade, which is reason enough to risk your money. And then all you have to do is you have to make sure that your risk to reward ratio is structured properly.
Okay, and that's what we're looking for. We're just looking for a 3R trade because, right, the dollar and the euro are not in sync. So
okay, so this is the one he's comparing it to. Remember, divergence means different. So he's looking for a difference. Now you see how different this looks, right? Hamza, look right here. Do you see how different this looks? Right? You can see the divergence right here. Let's just like kind of contrast them. This versus this. Sorry. This versus this. Okay? This, it's like when you're at the eye doctor, right? And they go this or this, okay? This or this. This or this. Do you see how they're different? Okay, that means divergence. So that's his second reason for entering the trade.
High. We obviously have some levels down in here that we're trying to aim for. So let me get into the actual trade execution. So you guys can see here that I actually took a loss ahead of CPI. And I was confident that this market was possibly going to just respect that daily volume balance and this daily inverted fair value gap. You guys can see with these blue and orange shaded levels, I actually went long here, just 2 contracts, but I was stopped out on CPI. So after I got stopped out, I just tried to reassess the situation. This is when I spotted the SMT divergence. Okay, after we got the hourly close, you guys can see at 9 a.m., got the hourly close, I pretty much entered right at that hour. So after the rollover from 9 a.m. going into that next hour, I entered long, okay? And then I scaled in another position. Now you guys can see here, after I scaled in the position, it spiked. So if you guys look at this price, 1.035.
Perfect setup, right? He got in long right there, and then boom, it just explodes to the upside, which is awesome.
75. If we look all the way across, okay, this is 1.03600. So I actually got in before it spiked. So this is part of scaling into the trade. I was very confident in this trade because I was getting that signature of SMT divergence. All right. So I was able to enter long here. This is a very, very, very good risk reward trade. So even if I lost a little more than 1R because I got slipped on this initial position, I was able to make up for it just by framing a better risk to
poor mental game. Never think about making up for your trade, although it is nice when it happens. So let's go down the list here. Identifying SMT divergence trades. What do you want to look for? One, you want to look for a divergence. What's a divergence? Difference, okay? So here are some examples of some divergences that you can look for. Now, when it comes to the trade breakdown, you know he's claiming 56K on this. Awesome, okay? And here are your steps. High time frame analysis, spotting that divergence, and then risk management and scaling it. Pretty simple, right? And then we've got some details. For him, there was the CPI news event impact. When it came to spotting the divergence, here were all the steps that happened. As you could see, he broke those down, including scaling in. Now notice he's exercising discipline and patience by not being overly confident and going all in right away. That's called scaling in. Excellent. And the third one is risk management, right? His first entry had a tight stop loss, 1R risk. Actually, I think it was 3, right? And then he scaled in, okay? So this was like his scaling plan, and we're going to see him break that down next.
Toward trade on that next entry. Okay, so if I was down 1R or down a little bit more than 1R because of slippage on CPI, I'm able to make it back by placing another 1R trade, but the upside has a great amount of potential. So after we got this run here, I was able to adjust my stop loss because we have a smaller 5-minute fair value gap. If you guys can't see it down here, I was able to scale in. I adjusted my stop loss, and then I was able to scale in. And this allows me to put on more size without assuming more risk. Okay, so before I scale into any positions, you guys can see here, I bought 2 here, bought 2 here. Before I buy that, before I make that second execution and buy 2 more contracts, I have to be able to reduce the stop loss on my initial entry. Because if I don't, now all of a sudden I'm exposed to 2R in possible risk.
Okay, now that's the key to scaling in. That is the key to scaling in. Go back and watch that over and over again. That is the key to scaling in, right? You have to keep your risk management rules in place. If you're going to scale in, you need to scale in without violating your risk parameters. If you get this, you can avoid blowing up your account.
Downside. And if I really wanted to, you guys can see here that as this market came back and retraced into this 5-minute fair value gap, I could have possibly added in again if my stop loss was at break even. So even if I added a third entry, I would have been able to, almost essentially triple my size without taking on more risk. Okay, so this is how you can turn a 1 to 2 or 1 to 3 or 1 to 4 trade into a 1 to 6, a 1 to 8, because your open exposure never exceeds 1R. Because if you get stopped out of all 3 of your positions, right, 2 of the positions are getting stopped out at break even, or even a little bit of profit. So your first position is getting stopped out in a bit of profit. Your second position is getting stopped out at break even, and then your third position is getting stopped out for a loss. Okay, so it pretty much mitigates that risk. So again, as you can see, right, the daily on the euro failed to take out the previous daily low. And this is really all I'm looking at. I'm looking at the daily time frame, and I'm just using the lower time frames to get in sync. I'm not really using the lower time frames to find setups. My setups are always coming off of a daily 4-hour or 1 hour level. I'm never using the low time frame to spot my bias and my setups. All right. I'm just using it for a timing tool.
So that's top-down analysis.
You guys can see here.
He starts at the higher time frames. He marks out his levels, and then once he decides what his levels are, then he's going to go into the shorter time frames and execute a trade.
That I timed it pretty perfectly. I pretty much bought the low of the day. And you guys can see here, right? Daily SMT with EU. We're still inside this bearish fair value gap.
And if you zoom out, right, this is the daily time frame, it looks like. Yeah, we're on a daily time frame here. This is a bull trend and then a pullback. Okay. And then what you see here is that the market's in a trading range. That's what a triangle is. So if you drew this, you could see it's this triangle. Okay. So he's buying low in a trading range, right? In a greater bull trend. So you've got the greater context working for you because the greater context is bullish. If we're looking at this as a bull trend, which it is, because we have the lows getting higher, which means higher lows, and we also have higher highs. Okay, so bull trend on a higher time frame. This is a daily. And then also, what else do you see? In terms of the momentum, what's happening right here, you're seeing, okay, we're in a trading range, and he's buying low in a trading range. So 2 reasons why this trade is excellent that have nothing to do with divergence.
We have low resistance liquidity below us. So here, right? The first move on CPI, oftentimes false. So you guys can see here, right? I took a loss initially. So I have $1,100 in realized loss. But you guys can see here, me being able to scale in, I'm making back that loss by almost 3 times, right? Without assuming more risk. So if I lost $1,000 on this trade, my first entry, I was risking another $1,000. And then my second entry, I was risking $1,000. But that first entry was moved to break even. So if I got stopped out of both positions, I'm only losing another 1R. So as this market was trading higher, right, we were getting additional validations to hold the position. So if you guys can look on the 1 hour time frame, we inverted that sell sign imbalance, and this is that retracement on that next hour is really where that third entry could have been. All right, and this is where patience and experience is going to come into play, because how many of you guys may have puked that trade as it's trading against you? Okay, because it almost came back. And, I gave back a fair bit of profits. I was up, almost 3R, came back probably up, 1R on this retracement. But I'm not worried about the P&L. I'm more concerned with, I have proper risk to reward on, and I have.
And that's excellent trading psychology. Excellent trading psychology, right? He's like, I'm not worried about the P&L. Do not trade your P&L. Everyone will tell you trading your P&L is not the right way to go. You want to trade the chart. Right? You want to trade the chart and you want to trade what you're seeing on the chart, not your P&L. That's excellent trading psychology. And it's something for you, me, for every single one of us to practice.
I have a clear draw on liquidity that I'm trying to aim for. I'm not concerned with the P&L. I'm just trying to look at the charts and make good trades. So again, right, both
That's it. Look at the chart and try and make good trades. That's it.
Positions are running very nicely in profit. So there you guys can see me scale out the full position. And look at the time aspect of it. We're a little bit past noon. So I'm taking into account, right, a lot of time of day. I'm thinking about, all right, this next 4 hour candle could possibly caused my position to turn around on me. So
And if this is a 5-minute chart as it is, you can see that here. He's in this trade for about 2 hours or so, right? So that's a long hold, which is awesome. So this is swing trading for those bigger moves, which is a really high probability way of doing things. And it's great for beginners as well, because you can just set it and forget it and let that trade work in your favor and even add on as long as you can manage your risk properly.
Is really only trying to operate within that 1 4-hour candle. And as you guys can see, we took out that point of liquidity. So here you guys can see I fully closed out those positions and made roughly $2,200 across 25 funded accounts.
Awesome. $55,980 in the bank. Cha-ching. Good for him. All right. So what are the key lessons? The key lessons are, number one, trading SMT without liquidity context. Solution. Always analyze daily highs and lows and fair value gaps. That's the solution. That's the mistake. Avoid the mistake and make sure that you are using those higher time frames. Mistake number two, overtrading and taking every divergence. Now, he started the video by sharing that this is the common mistake that most traders make. Instead of taking every divergence with this strategy, you want to look for confirmation from liquidity and market structure before entering. And the third common mistake or best practice is going to be using that divergence as a secondary confirmation tool. Now, remember, I pointed out to you just understanding what's happening with the price action. Are we in a bull trend? Is this a pullback in a bull trend? Are we buying low in a trading range? Because you want to buy low in a trading range. You don't want to buy high. Okay. So those are all other reasons to enter a trade. Then you can use divergence as a secondary tool, which is awesome. Now, here's your Trades by Brent Action Challenge, because I know that you came here to apply what you learned in this video and not just be entertained, so that you can take something from this video, apply it, and make some of this. Here are your 2 action steps. Number one, you've seen the power of divergence. It's time to put it into action. So watching is one thing. You got to apply it. This is what separates the winners from the losers. So level up, take on the action challenge, and do these 3 things. Number one, backtest the divergence strategy on your chart, okay? Pick 5 to 10 days of historical data for correlated assets. Here's an example. Pick your favorite. Then mark every divergence setup and take some notes and ask yourself the following questions. Number one, did it lead to a strong move? Number two, what confirmations worked best? And number 3, what could have made it even stronger? Your action step number 2 is to set up a demo trade with the divergence strategy. So find a real-time SMT setup and execute it on a demo account. Use the same entry and risk management rules from the video. Okay. Wait for that daily high-low sweep that doesn't confirm on both assets. So that's the disagreement or the divergence. Then identify a liquidity zone or fair value gap to enter from. Set a reasonable stop loss and only scale in when in profit. Only scale in when in profit. Okay. Now, if you didn't know this, one of the number one reasons why losing traders lose is they try and scale into losing positions. Do not do that. Instead, only scale in if you're winning and in profit. Now, your third action step is to build a pre-trade checklist for SMT setups. Before entering any SMT trade, ask yourself the following 4 questions. Here they are. Are the 2 assets diverging at key levels? 1. 2. Is there a liquidity target? Those could be equal highs. That'd be a double top, or equal lows. That'd be a double bottom for price to aim for, right? The market is going to try and take out or break out of those support and resistance levels. So you can use them as targets, right? That's the aim. Now, number 3, have I waited for confirmation on the higher time frame? Notice he said that he uses those higher time frames for pretty much the whole thing, and then he just goes down to that shorter time frame to make that execution. But all the levels are marked out at those higher time frames. So make sure if you're trying to execute this strategy as outlined by JadeCap, that you're using those higher time frames and you're waiting for confirmation there before going to the lower time frames. And then your 4th question to ask yourself, do I have a defined stop loss and exit plan? Never, ever, ever enter a trade without a predefined stop loss and profit target. Okay. So that is the Trades by Brent Action Challenge. And I invite you to say yes to the challenge so that you can apply what you learned from this video and actually transform your trading results. If you're curious about my strategy and you want to know more about how I trade or the setups that I look for, go to tradesbybrent.com and I have a free downloadable PDF and I'll share with you my 3 favorite trades and I'll break down the 3 patterns I look for. I'll show you examples on the chart and I'll also explain how I limit my risk, set that profit target, and get that profit before it's too late. Tradesbybrent.com is how to check that out. If you're curious about the tools that I use to trade, like this one right here, which is TradingView, and the prop firm that I use, I trade with the prop firm and I trade with TradingView, and all the rest of the tools that I use are in the link in the description. Check that out. And also, if you want to learn with me, hit the link in the description as well, and I will invite you to join me in my premium Patreon where I do training videos like this, but way more in depth. So if you want to go deeper with me, check out my private group. That's patreon.com/tradesbybrent, or just hit the link in the description. Hit that like button if you like the video. Subscribe if you want more from me. And next, I recommend you check out this video, which is related, which will take what you learned in this video to the next level. Watch that right now. I'll put it up on the screen.